Here's a question. In a financial crisis, are bank deposits safe? Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. In Australia, currently, bank deposits up to $250,000 are protected by government guarantee. Only deposit products provided by ADIs or banks, which are supervised by APRA, are eligible to be covered. Amounts between $250,000 and $1 million are not covered under the guarantee scheme, although above $1 million, banks can elect to pay a fee to the government for this protection. But all of this is not obvious. It's up to individual ADIs whether they choose to apply for this approval to offer guaranteed large deposits. The same fee schedule currently applies to ADI's large deposits as to its wholesale funding. But the question is, how watertight are these arrangements? And what might happen to higher value deposits in a crisis? There were several well-publicised government bailouts of banks which got into problems after the GFC. For example, the UK's Royal Bank of Scotland was nationalised. This cost taxpayers dear. So subsequently, there were measures put in place to try to manage a more orderly transition when a bank gets into difficulty. In October 2011, the Financial Stability Board issued its key attributes for effective resolution regimes for financial institutions. We'll call that key attributes from now on. These key attributes set out the core elements that the FSB considered to be necessary for an effective resolution regime. There followed legislation in a number of jurisdictions. For example, the European Union introduced the Bank Recovery and Resolution Directive, 2014-59/EU. The US, the Dodd-Frank Title II Orderly Liquidation Authority. And in New Zealand, the Open Bank Resolution, not to be confused with open banking, which we discussed last week. This is a summary from New Zealand, but note the chilling words. The bank closes temporarily, and some money is frozen. Banks reopen under statutory managers. Customers can access non-frozen portion of their money, which is now government protected. Frozen money can be used to help resolve the bank's issues. Resolution of issues completed, unused portion of frozen money is returned to customers. Or, in other words from that schematic, customers' money held as savings in the bank are able to be grabbed to assist in the resolution. This is, of course, what happened to people with bank deposits in Cyprus a few years back. The thinking behind this is simple. Banks need an exit strategy in case of a problem, and government bailout should not be an option, they say. So, a manager can be appointed to manage through the crisis. They can use bank capital, other instruments like hybrid bonds, and deposits to create a bail-in. This approach to rescuing a financial institution on the brink of failure makes its creditors and depositors take a loss on their holdings. And this is the opposite of a bailout, which involves the rescue of a financial institution by external parties, typically governments using taxpayers' money. So given the New Zealand position and the tight relationship between banking regulators in Australia and New Zealand, we should look at the position here in Australia. Are deposit funds in Australia likely to be bailed in? Well, as it happens, there has been a long-running discussion on this in Australia, and on the 16th of November 2017, the Senate referred the Financial Sector Legislation Amendment Crisis Resolution Powers and Other Measures Bill 2017 to the Economics Legislation Committee for inquiry and report by the 9th of February 2018. They've just reported back. It all centred on the powers which were to be given to APRA to deal with the banking collapse. The bill seeks to strengthen the powers of the Australian Prudential Regulatory Authority, APRA, to facilitate the orderly resolution of an authorised deposit-taking institution. or insurer, so as to protect the interests of depositors and policyholders and to protect the stability of the financial system in case of a crisis. The Treasurer had argued that by affording APRA the power to work with ADIs and insurers in order to plan for economic stress events, the cost to the taxpayer will be significantly reduced in the event of a financial crisis. The Senate review and consultation elicited a significant number of submissions, and they made two main points in opposition to the bill. Firstly, they believe that this bill does give APRA the power to bail in depositors' savings to stabilise a falling financial institution. And secondly, in place of the bill, the Australian Parliament should legislate a Glass-Steagall style separation of the banks. Specifically, Dr. Wilson Tsai, a former analyst with APRA, considered that the bill was not clear enough on the topic of depositors' savings. Dr. Tsai suggested that deposit protection is to be balanced against financial system stability, without the law clearly stating which has the higher priority. Dr. Tsai claimed the bill is designed to confiscate bank deposits to bail in insolvent banks to save the financial system. It came down to the meaning of any other instrument in the draft bill. Treasury said the use of the word instrument is intended to be wide enough to capture any type of security or debt instrument that could be included within the capital framework in the future, but it is not intended that a bank deposit would be an instrument for these purposes. And Treasury confirmed that because deposits are not classified as capital instruments and do not include terms that allow for their conversion or write-off, they cannot be bailed in. So the committee concluded, the committee believes that the protection of depositors' interests is paramount and does not consider that the bill would allow the bail-in of Australian savings and deposits. The stability of the financial system depends on its depositors having confidence in its financial institutions. By ensuring the security of depositors' savings, the overall protection of the financial system can be ensured. But there are a few questions to consider. Why not expressly exclude deposits from the bill? The current vague wording appears to leave the door open for a deposit grab in case of financial instability. We may have some reassuring words from the regulators, but is it enough? Secondly, how does this fit with the New Zealand model, where the deposits can be targeted, especially as the regulators in the two countries are closely aligned, and in fact most banking in New Zealand is provided by Australian banks? In case of failure, would customers of a bank operating in both countries be handled differently? And two wider questions. The New Zealand model expressly says that depositors should weigh up the risks of placing money with specific lenders. But can savers really do this? Most people would think that savings will be secure wherever you place them. The issue of hybrid bonds needs more careful consideration, in that in Australia, unlike some other countries, these bonds have been sold to retail investors, people looking for savings with good returns, and who probably do not understand the bail-in risks they may face. So even if deposits are excluded, there is a risk that investors in hybrids will get a nasty shock. It seems to me this is a messy area, and I for one cannot be 100% convinced that savings will never be bailed in. And that's a worry. I recall the Productivity Commission comment last week that financial stability has taken prime place compared with competition and so customer value in financial services. The issue of bail-in of deposits appears, in my view, to be shaping the same way. If you found this useful, do like the post, subscribe to receive future updates, and check back next time. I'm Martin North, Principal at Digital Finance Analytics. Many thanks for taking the time to watch.